You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 11/24/21, Thanksgiving week. We're having a light week this week, so please bear with us. Got to spend a little time with the family, etc. But we still want to bring you important information. And as always, we welcome your emails, kl@kerrylutz.com. That's the place to reach me. Well, Jerry Fetta is with us now. His site, something I think you want to take a look at. Jerry is really what he's got called the Blueprint to Financial Freedom. And I think you can get that for free. Jerry will tell you where to get it a little later. But Jerry, welcome to the show. And tell us, how did you get started in this business?
Thanks so much, Kerry. Man, that's about 10 years ago. I got into what I refer to as mainstream financial services. And so I was doing a lot of kind of traditional 401ks and mutual funds and different things of that nature, more on the retail side with investors. And as I learned more and more about macroeconomics and kind of what really is happening behind the scenes, my business has evolved tremendously. And so I went from doing that to the company as it is today, Wealth Dynamics, really helping people, first gain financial education, second, become solvent. A lot of Americans just simply aren't. And then third, achieving greater financial freedom through owning real assets, passive income, reducing taxes, all of those great things.
Cool. So you were in the mainstream financial system, and you had a wake-up call. What was it that made you realize that maybe there's a better way of doing this?
It's a funny story. When I first got it started, and this is again back in about 10 years ago, I remember one of my very first appointments was with my best friend's dad. And I've known my best friend since I was 13. His dad, I would always see him not working, yet somehow their family always had money. And I knew well enough to know that that's not how it works, right? Because when my parents had been employed, we definitely, food, groceries, all those things became more constricted. I didn't see that with them. And so I had one of my first appointments with him, and I sat down and kind of showed him the deal, the main thing that we were going after selling. And it seemed like after I explained it to him, he knew it better than I did, and he just wasn't interested. And at the end of that meeting, I was 18 years old. He said, "Jerry, when you're ready to learn how money really works, I want you to come talk to me." And that sat with me for several years. And later on, that kind of opened back up again. The movie The Big Short came out. And so I watched that movie. There was a book that actually his son had recommended, was The Creature from Jekyll Island by G. Edward Griffin. So I also read that. And then there was a video series I watched called The Hidden Secrets of Money. And so I went from being kind of a Wall Street financial advisor to then seeing, the inner workings of what's actually happening in our financial system in a matter of a few short weeks. And that was kind of my wake-up call.
Okay, so you kind of got hit to the way of the world, the fact that the Federal Reserve through interest rates manipulates rates, and hopefully from their standpoint anyway, the economy as well, and so a light bulb went off in your head.
Yeah, exactly, and I really realized that the retail investing that I was, helping people with at the time, it's not how the wealthy actually invest. If you talk to, any top 1%er, they're not going to tell you they own mutual funds. They're doing a lot of other different stuff. So that really led me on the journey of then asking the question, well, what do they invest in? I read lots and lots of biographies and historical records and just books and everything I could get my hands on about what do these guys actually do to build their wealth.
Okay, so a search ensued. And what was the biggest wake-up call that you had? What was the most surprising thing to you of everything?
I think the biggest wake-up call that I had was how uniform a lot of these top 1%ers are. And when I say top 1%ers, I'm talking about old dead people, right? So looking at Rockefeller, Carnegie, JP Morgan, that group and seeing, within their own unique businesses, sure, they had their own stuff, but the things they did with their assets were very uniform across the board. After they got the income, where they were placing it, how they were structuring it, it's kind of the same thing over and over. And so I think that was the biggest wake up call. And then paired with the fact that a lot of the wealthy don't actually use financial advisors. They use something called a family office. And so it really is a separation of classes and services offered to those classes. So I think that was probably my biggest eye opener.
Oh, interesting. So just many of you out there don't know what a family office is. Tell us what's a family office here, Jerry.
Yeah, so a family office, this goes back to the late 1800s. This was kind of coined by John D. Rockefeller. It really is the individual creating their own wealth management company. So rather than hiring a financial advisor or outsourcing it, they're hiring staff, they're hiring executives, they're teaching these people how to do what they did as they built their wealth and as they built their portfolios. And it basically is turning it into a business. They can get into the point of, okay, now if I've got this portfolio, but I also have all these people running it for me. And a lot of times that leads into then including kids and grandkids and making it into a generational thing.
All right. So family office, also they get certain tax benefits from that because family office is kind of like a hedge fund and you get carried interest, right?
Yeah, there are definitely tax benefits that go with doing it. And when you look at the fee structure, like if you were to take, let's say a 10 or a $15 million portfolio and say, okay, great, let's just put that in mutual funds. What are the fees on that, right? And if that's maybe 1.25% a year that someone would pay, if you take the dollar equivalent and you look at, well, how many people could I hire, right? Because a lot of times those fees on the mutual fund are not going to be tax deductible, but payroll is. And so that's another just basic way where you can look at, the tax benefits of doing it this way instead.
I see. So this was a real eye opener to you. So your best friend's father there, you still in contact with him?
Yeah, he's a business partner of mine now. And I came to learn, he was a real estate investor. That's why he didn't have to work, because he had passive income. And so he's somebody that I work very close with now.
Interesting. So you really did get something out of this, and amazing how the quest for knowledge really takes you to places you never expected to be.
It really is. There's always truth out there somewhere if you're willing to go look for it.
Mm-hmm. So your clients now, what are they investing in?
So we do a lot of different things. We do a lot of gold and silver. So we're big into physical, tangible gold and silver. We do a lot of high cash value life insurance, secured private lending. For my accredited investors, we do, oil and gas funds, hedge funds, Forex funds. There's a lot of different things out there. But the main problem that we're trying to solve is the equation of passive income exceeding savings, expenses, and taxes. So we call that PI greater than set. All of our investing is geared towards helping someone achieve that.
Mm-hmm. Okay. So all right. Life insurance, is that part of a strategy? Do you think everyone should have a life insurance policy? What's the deal with that?
Yeah, so that's a kind of a main fundamental. It's a very basic thing. So there's a lot of life insurance out there. The specific kind that we're talking about is called high cash value, and it's a dividend paying whole life insurance policy. If you do some research, there's what's called bank owned and corporate owned life insurance. And so if you look at Bank of America, for example, I believe they have $22 billion of their assets in this specific kind of life insurance. But it serves as a very good tier one reserve pool, meaning it's going to be your most prized, reserves or cash, equivalent. It can't lose. It goes up in value. It's not taxable. It's protected against creditors. It's protected against lawsuits. So it does have death benefit. That's kind of, you can do what you want with that. You can insure different people. But from the standpoint of, where do I put a good chunk of cash reserves? I believe everyone should look at this.
Okay. But banks are insuring their employees, right?
Oftentimes they are. They'll put the actual death benefit on the executive, and then, they'll have the cash value owned still by the bank. So, they're able to have the liquidity and the cash, but then also when that employee passes away, the death benefit pays back to the bank. Rockefeller Trust has the same kind of setup. When a beneficiary takes money from Rockefeller Trust, they have to get a life insurance policy, and the beneficiary of that policy is the trust. So in a way, it kind of refunds any withdrawals, any disbursements that cost on that person's life during the period of their withdrawals.
Mm-hmm. All right. So, all right. Aren't there high fees associated with this?
There can be if you design it incorrectly. So if you design it correctly, if you just think about, if you take, let's say, just for easy numbers sake, let's say $100, and you put this into one of these life insurance policies, you should be able to get it to where 70 to 90% of that $100 is immediately available in cash. And then the reciprocating, $10 to $30, that actually buys your death benefit. With the design of this, by buying a death benefit, you're actually buying ownership in the insurance company. So that actually produces dividends. So it's kind of like owning a unit of income producing assets. Long story short, that death benefit ends up paying for itself through the dividend yield. And so typically, the fifth through maybe the seventh year of the policy, you'll have what's called a break-even point, which means all of your costs have been recuperated, and you could actually put no more money into that policy ever again, and it would just keep growing.
Right. So in the bank's case, all of this is tax deductible as well, right?
It can be. So the rule with life insurance is because the death benefit is tax-free, then you can't also deduct the premiums. If you want to deduct the premiums, then the death benefit cannot be tax-free. So it's kind of like double dipping. So we like the fact that the death benefit and the cash value is tax-free, so we don't recommend deducting it. There are other ways, there are other tax planning things you can do to reduce the tax burden without, deducting a life insurance premium.
Interesting. So tax treatment varies, and probably the banks deduct it because the money they're putting in is way more than the death benefits than they're receiving back. So they probably come out ahead. But for individuals, obviously the situation is going to be different, and you're, not going to use it, but it would be a business related expense. And then there's all sorts of federal laws that apply to that. So we don't need to get into all that complicated stuff, but just keep in mind that there are benefits to both ways. So cash life, what's your feeling with precious metals? I mean, I'm a big precious metals bull. However, precious metals haven't behaved that well as of late after hitting their all-time high in August of 2020. They've kind of been down the drain since then. Why do you think that's going to turn around?
Don't just survive, thrive. The Financial Survival Network.
Today's show is brought to you by Mustango River Resources. Their flagship projects are located in Kirkland Lake, an established gold camp that has historically produced over 70 million ounces of gold. The Kirkland West project is a high-grade gold project beside Kirkland Lake Gold's world-class Macassa gold mine, one of the highest-grade mines in the world. The Umeja project is an advanced stage project with 600,000 plus ounces of gold along the Cadillac Break, 25 kilometers east of Macassa. Their projects have the potential to transform into another world-class mining camp in the Kirkland Lake District. Make sure you go over to Mustango.com. That's Mistango.com. Take a look and sign up for notifications. Stock is traded on the Canadian Stock Exchange, ticker symbol MIS. For more information and to sign up for notifications, go to Mustango.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, so I think with precious metals, there's a couple of factors to look at. I'm a big precious metals nerd as well. So basic math, if we go back to like third grade, there's the numerator and there's the denominator, right? So prior to 1971, everything was gold, right? The dollar was actually valued in gold. And so if you look at that, gold was actually the thing that everything was denominated in. And so, it didn't really matter like the price of the dollar, what the economy did, it was all linked to how gold performed. That flipped after 1971. Now gold is denominated in dollars, but it's still numerated as itself, right? And so for me, the dollar price of gold has nothing to do with the value of it. The value of it is intrinsic. It has to do with its properties, uses, scarcity levels. And so I think, the Federal Reserve, you can even look at some of the large chain banks that are out there, can very easily manipulate the price of gold. And they do that because they can make money on ups, downs, and sideways, right? They're trading it. They're doing a lot of different stuff with it. So when I look at what's gold going to do in the long run, gold always does mirror inflation. It doesn't always do it greatly in the instant second it happens, because it also is very based on consumer emotion. And so right now, for example, inflation is definitely happening, but I don't think a lot of people are acting like it. I think a lot of people still are a little bit in denial and kind of pretending it's not really going to happen. It'll continue to. And when it does, I think that's the point where we see gold really, rightfully soar up to the price that it should justifiably be at.
Mm-hmm. Okay. And I kind of see your point. So let's talk about inflation here. Inflation, Will Rogers said, invest in inflation. It's the only thing going up. And that would seem to make the argument for, for basically real estate in a lot of ways, right?
Yeah. So I think, commodities are a good thing to have. Real estate is a good thing to have. Inflation definitely always will and always has gone up. So I think that that's a fair point. One thing that I have the personal viewpoint on is if something is in a constant state of change, it's not really a new thing, right? So we can look at inflation since 1913. It's been happening at a very drastic level. Even prior to that, it was lower levels, but still existent. So it's one of those things that you kind of just have to realize it, just like the stock market, it's going to have its really high years and its really low years. On average, the real inflation rate historically is about 5 to 6% a year on a compounding annual growth rate basis. So if I know that, then I need to just factor that into my investing. If I do commodities on the up years when inflation booms, I should soar. The downside is on the years where it's not as high, my commodities might not do as well. And so I think that's where you look at, okay, bottom line is my nominal basis that I have to out earn is 5 to 6%. Just to break even past inflation, whether that's an income asset, whether that's a commodity, that's my target number.
Okay. So, and that's definitely what we're seeing now. So any cryptocurrency exposure here?
Not for me personally. I think it's still a very speculative play. Sure, you can buy it and it'll go up if more people buy it with you, but it's not something that I look at as an asset class that I would put money into.
Okay. Well, I hear you. I understand what you're saying, but, I think it's in the past 10 years, it's kind of proven itself, much to my chagrin and amazement. I never really expected it to get to this point, but here we are. So what would it take for you to change your views on cryptos?
For me, there's a quadrant that I look at whenever I consider an asset. So it's got to have 3 of the 4 characteristics. At a minimum, 4 or 4 would be best. It's got to have track record. It's got to have earnings. It's got to have intrinsic value. And it's also got to have extrinsic value. Track record, I think Bitcoin is the longest track record with, 10 or 12 years, right? Sure. Crypto in and of itself does not have earnings. Sure, you can yield farm and you can do different things, but an actual token doesn't just pay a yield in and of itself. It doesn't have intrinsic value. It does have extrinsic value. So it's only really got 2 of the 4. And that's with, an established one like Bitcoin. Others, really, it's only got 1 of the 4, which is extrinsic value. So it would need to have at least 3 of the 4. 4 of the 4 would be preferable. And I would need to see that the intrinsic value is actually higher than the extrinsic. Meaning if nobody wanted it, would I still have something worth, my money's, that I put into it?
Yeah. But, like 12 years of these phenomenal returns, and going back to inflation, where we see the Federal Reserve is kind of like all in on modern monetary theory. It seems like, and correct me if I'm wrong, like people are kind of waking up to this scam, the scam of central banking, and are looking for alternatives. And you sound like you're a bit of a libertarian, if you will. So we could go back to Milton Friedman. Well, actually, Murray Rothbard. The concept of competing currencies, right? Mm-hmm. And to actually have alternative currencies that compete against the official legal tender as designated by the Federal Reserve, by the federal government. And we've got a situation here now where, for the first time since I've been alive, we actually have competing currency, which is kind of interesting. Granted, I agree with you. It's kind of like maybe it's in the experimental phase right now, but you can't ignore it, is what I'm saying. You ignore it at your own peril, which hey, I did for a long time. I've been in and out of it over the years. Sorry, I didn't get into it more when I knew about it, but nonetheless, it's got some major proponents, and it's starting to get global acceptance from the very people you wouldn't think, the financial center banks, the JP Morgans, et cetera. They're all seeming to go into this thing. So do you revisit your views on cryptos regularly? I know you told us what it's going to take for you to get into it, but just as a you're a younger guy, you're supposed to be into this tech stuff, right?
Yeah. So, I mean, I keep up with it. I definitely am up to speed with the current times. My brother's very into it. So I get the text messages from him once every 2 or 3 weeks on what the newest thing is. But, for me, I really look at to have a competing currency, it actually has to have use case as a currency. And I have not seen that we have that yet, meaning you can't, things are not denominated in Bitcoin or in Ethereum yet. They're actually gone through a cash exchange. So a lot of the merchants that you can pay with, they don't actually want the crypto. They'll just take it through the processor, who then changes it immediately into dollars. So taxes are still paid in dollars. Everything that we do is still dollars. I think for us to really have that in a sense of competition, we have to look at who we're dealing with, which is the Federal Reserve Bank and the powers that run that. In my opinion, it'll take a lot more than just creativity and good technology to break out of that system. Okay.
I think that's a fair assumption there. But what about just keeping a couple percent of your money in there, like say 3 to 5%? Is that a bad thing?
I think it depends on where you are at, right? So if someone's not financially free yet, every dollar counts, and they need to have that going towards building up their passive income. So I think if somebody's not at that point, then I don't recommend putting any in it. It's kind of like going to Vegas. If you're broke, you don't go to Vegas, right? Like you go get a job, go work, go build up your assets, et cetera. If you've got the money to lose, sure. Right. And that's where, if you make, 10x return, great, but you might lose all of it. And you got to be able to look at that and say, okay, I understood that could happen. And that's money I'm not going to miss. Okay.
And I totally get where you're coming from. And, it's not that I disagree with you, but I think this is an important trend that you need to be following. All right. So I guess if you're looking ahead at an investment that you're really excited about, that you really think really has the potential to make big moves, like you said, because if we look at inflation at 5 to 6%, although right now, obviously it's far higher than that, what's going to keep up with inflation and maybe even exceed inflation in the coming months and years ahead of us, Jerry?
Yeah, inflation is an interesting thing. So there's really two parts to it. There's the expansion of the money supply, which can be done through creating currency and lowering interest rates and issuing loans. And then the other side of it really is just good old price increase. And so it's kind of two sides to the house. As a business owner, I can bump my prices up, and it doesn't have to be analogous with an inflationary environment. I can just decide I'm going to charge more. Or it could be because, my wholesale costs or whatever went up. So when I look at that, inflation is kind of like a gun. Wherever it's pointed at whatever asset class or sector, that's the one that's going to go up. In 2020, most of the money printed was pointed at institutions. It was not pointed at consumers. And so that's where we see, stock market ripping at all-time highs, real estate, all these different things that are asset classes. Just now we're seeing goods and services starting to increase in price. And that's because those businesses have a lag on spending the money, getting it into circulation, and people actually using it. I think we're going to see more of the same. I believe that the government's going to have to keep doing these subsidy packages. They'll bail out their cronies like they always do. I think on the consumer side, ultimately, we're probably going to see an increase in prices on just goods and services as well. So I think At this point, if you want to just ride inflation up, you could probably pick a paper or a digital asset and it's going to go up just by nature of money printing. If you're looking at the long game, you can strategically get into some of the consumer goods where you might see some supply chain issues, some restriction, maybe some scarcity, or maybe even just some good old fear or greed associated with it.
All right. And I think it's really good. Hey, a lot of your job here, education, not just for your clients, but for the younger people who really don't understand how the game is played. How are you reaching out to younger people? And because they're your future clients, obviously, how do you connect to them? How do you explain to them this game that's being played?
Yeah, that's a great question. So I'm kind of a younger guy myself. I'm 29. And, when I look at the people that are up and coming and they're going to be the future generations, 18, 19, 20 something. I remember being that age. And so, I do a lot on social media. We do, I think two live courses every week on finances. On Mondays, we have one called Money Monday. We're actually going through the book Money Mischief by Milton Friedman and kind of doing a report and simplifying those concepts there. So great book. And then on Fridays, we do a course as well. And that one really is topical. I teach that on everything from getting out of debt, handling taxes, whatever it might be. But with the younger generation, a lot of us like freedom. We like the ability to travel. We kind of watched our parents do all of what they did, and it's not something we want to repeat. But the bottom line is that economics is involuntary. And so if I really want to have the freedom, I have to understand how finances work so that I'm not out there, swimming in the ocean, to put it as an analogy, without the ability to swim or knowing what I'm doing.
All right. Well, hey, Jerry, really appreciate you coming on, sharing your views with us. We agree with you on many of the things you mentioned. Life insurance, I see the benefits, but I'm not so sure about it. Cryptos, maybe need a little bit more of an open mind on it, at least putting in inconsequential money, roundups, whatever. But people want to find out more about you, what your services are, your philosophy. Where do you go?
Yeah, so on social media, you can find me at Jerry Fetta. My last name is Fetta with 2 T's, like the cheese, but 2 T's because it's twice as good. So if you go to Jerry Fetta, I'm very active on Instagram, but really any of the platforms work. If you want to go to my website, you can go to wealthdynamics.com. That's wealth, dynamx.com. And we have a lot of free content. We've got articles, videos, podcasts, where there's a lot of books, different things on there to just dive in and start learning.
All right. Hey, we really appreciate you coming on. Any questions for Jerry, myself? It's KL@kerrylutz.com. Don't forget, go to our site, financialsurvivalnetwork.com. Sign up for your free newsletter. Jerry, been a pleasure. Good luck. We'll talk to you again.
Thanks so much, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.